Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about taxes. We're in the middle of tax season right now, and it has been a while since we covered the basics of how taxation, particularly income taxation for business owners, works here in the United States. So in today's episode, I just wanted to walk through a couple basic tax principles for business owners, including the difference between deductions and credits, how our marginal income tax brackets and system works here in the U.S., and what you should think about if you're the owner of a pass-through business entity. There are a couple very common misconceptions I run into in my financial planning practice, and in today's episode, I wanted to take a couple minutes to clear them up. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Hello, everybody. Today on the show, we're going to be talking about taxes. We're in the middle of tax season. As a caveat for this year, please be nice to your tax preparers. In general, they're having a challenging time this year. I know a lot of people out there are looking for help with their taxes this year, and there's simply not enough accountants to go around. A lot of people are having a hard time finding good, responsible accountants who are communicative and can prepare returns for a reasonable rate. There's not a whole lot of them out there taking on new clients these days. The accounting profession has lost, I heard, 300,000 professionals, tax preparation professionals in the last couple of years, partially because of COVID. All the COVID era regulations created a lot of stresses for accountants. There's a lot for them to keep up on, keep track with. And I think the average age of accountants was relatively old, and that pressure just pushed a lot of people out of the industry. And like a lot of professional industries, they're having a hard time recruiting new people into the business. So long story short, be nice to your tax person this year. Try to get them your documents, your tax stuff as early as you can. What I'd really like to talk about today is basic taxation for business owners. We talk a lot about various tax strategies, various things that you can do to reduce your tax liability for your household and your personal finances, but also for your business on the show. We have experts come on and share strategies. I share a bunch of stuff that I know that are great strategies for reducing taxation. But it's been a while since we've touched on just tax basics and the stuff that you need to know. And so where I'd like to start today is just talk a little bit about the difference between credits, deductions, marginal versus effective tax rate, and how our tax brackets are actually put together. And to start us off with a really basic example, let's just assume that you have a business where you sell ice cream cones out on the in the hot weather out on the street corner every day, and you have $100,000 in net profit from your ice cream cone sales. That's after your expenses. So maybe you have, I don't know, $150,000 of revenue from your ice cream cone sales. It cost you $50,000 to buy the materials, so you have $100,000 left over. Well, from a tax perspective, you now have $100,000 of income to report on your tax return. And for simplicity's sake, right now I'm going to ignore the self-employment tax, FICA payroll tax if you're either an employee somewhere or perhaps the employee of a company in which you own that could be taxed as an S or a C corporation. I'm going to ignore all that stuff. Let's say you have $100,000 in income. You report that on your personal tax return, but then you get to take some deductions. And if you have mortgage interest that you pay, and maybe you give some money to charity, maybe you pay state and local taxes in some way, shape, or form, You add all those up. Those are all eligible itemized deductions. You add them up, and if the sum is greater than the standard deduction, then you itemize your deductions. But let's say that you're renting, you don't own a house, and you live in Texas where you don't pay any state income tax, and you haven't given anything to charity this year. Well, you have no itemized deductions. And so if your deductions are less than the standard deduction, which is the deduction that everybody is entitled to take on their taxes, even if you have no itemized deductions, everybody can take the standard deduction no matter what. So if your itemized deductions are less than that amount, which this year is 13,000 and change for single filers and about 27,000 and change for married people filing jointly. That's for 2023, by the way, not 2022, which we're all preparing taxes for now. At any rate, if your itemized deductions are less than those thresholds, then you just take the standard deduction. So let's say in our example here, you have a total of $30,000 of itemized deductions between mortgage interest, charitable gifts, and state and local taxes paid. You add those up, you get $30,000 of deductions. So you have $100,000 of income coming in from your business. You have $30,000 of deductions. That leaves you with $70,000 of taxable income. And taxable income, after accounting for those deductions, that's what we apply to the tax brackets, which I'll explain here shortly. So let's talk about a credit versus a deduction. A deduction, like I was just explaining, reduces your taxable income. So let's say that you want to pay less in tax, and at the end of the year, you cut a $5,000 check to your local charity. Remember, you have mortgage interest, you have state and local taxes that you pay, and maybe some other charitable gifts. The total is $30,000. Well, if you cut another check to charity and increase your itemized deductions by $5,000, now you have $35,000. And so, without making that extra charitable gift of $5,000, you have $100,000 in gross income minus $30,000 of deductions, leaving you with $70,000 to pay tax on. If you make the charitable contribution, you still have the same $100,000 of income, but now you're taking $35,000 of it away and paying tax on only $65,000 instead of $70,000. That's a deduction. A deduction reduces your taxable income, meaning that you have to pay a little bit less in tax. A credit is a little bit different. So let's say that you have $70,000 of taxable income, and on that taxable income you pay, let's call it $15,000 in income taxes. And I'm just pulling this out of a hat, by the way. So if you have a $3,000 tax credit, that means that it's a credit toward the tax bill that you have to pay the IRS. So again, to recite the example, you have $100,000 in self-employment income. You take out $30,000 of that for your deductions. You're left with $70,000. Well, that's $70,000 you owe $15,000 in tax on. A $3,000 credit means that of the $15,000 that you owe, the IRS is going to credit you $3,000. So you only have to pay them $12,000 instead of the full $15,000. And that's really valuable. So let's compare that to a deduction. In a deduction, you have $100,000 of income, $30,000 of deductions. Let's say you get another $15,000 deduction. Instead of cutting the extra check at the end of the year to charity for $5,000, you cut it for $15,000 instead. Well, now you're reducing your taxable income by $15,000. So from $70,000 to $55,000. And rather than paying tax on $70,000, you're paying tax on $55,000. And if your effective rate is, I don't know, call it 15%, then that's helpful because it reduces the amount that is applied to the tax brackets. So every single time, no matter what, a credit is more valuable to you than a deduction. Because remember, a credit is, let's say, for $3,000, means that the IRS is going to make you pay that much less tax on your bill at the end of the year. But a $3,000 deduction only reduces that taxable income. That's the pool that you have to apply the brackets to. And it will save you money in taxes, but it's not as valuable to you as a flat $3,000 credit. So that's an important distinction we need to make first off. And a comparison between the two is helpful. I probably could have run some exact numbers here to compare the two, but suffice it to say that a credit is always, always, always more valuable to you than a deduction. Now, the most common misconception about the tax brackets that I get is how these things are structured. We've got several different income tax brackets. It's a progressive system, as you know. The more money that you make, the higher rate of tax the IRS assesses on it. So the way it works is the first little bit of your income is taxed at 10%. And anything above that level is taxed at 12%. The bracket above that goes from 12 to 22 to 24 to 32% to 35%, and then ultimately to 37%. And there are a couple other shades of gray in there at above other thresholds. You're expected to pay the net investment income tax or the additional Medicare surcharge on or Medicare tax on income, Medicare premium surcharges as well if you're enrolled in Medicare already. There are all these other shades of gray, but in its most basic form, we have this marginal tax bracket. So if you make $100,000 of income, you're probably going to be in, let's call it the 22% tax bracket. It obviously depends on whether you're filing as a single filer or a married person filing jointly, because the levels at which each rate is assessed depend on your filing status. But let's say that, just for argument's sake, you have $100,000 of taxable income, and that's in the 22% bracket. That doesn't mean that your tax bill is $100,000 multiplied by 22% for $22,000. That's not what it means. It means that any additional dollar of income will be taxed at that 22% marginal rate. But even if you have $100,000 in income, it doesn't mean, again, it doesn't mean all of it is taxed at 22%. It just means the amount that wound up in that bracket. The first small bit of your income is still going to be taxed at 10%. And if you have any income after you've filled up that bracket, that next amount is going to be taxed at 12%. And if you have enough income to fill up that bracket, then it goes from 12 to 22, right? And so it doesn't mean that by bumping up into the next tax bracket, immediately all of your income is subject to that higher tax rate. It just means that the next dollar is. And that's an important distinction that I think a lot of people misinterpret in general, and is really important to know for planning purposes. And that's why we say, when we talk about doing Roth conversions and things of that nature, that if there's ever a year where you're in a lower tax bracket, we want to use that to your advantage and fill it up with a Roth conversion. Because chances are later on in life, when you're going to be distributing from that account, you might not be in the 12% bracket ever again. You might be in the 24 or the 32% bracket. And it's much more effective to trigger the income when you're in a lower bracket of taxation. Because even if you have some unexpected income come in that you don't that you weren't anticipating, by bumping up into the next bracket up, it doesn't mean that all of your income will be therefore subject to that higher rate. It's just the next little bit of extra income you weren't anticipating. So those are three things that are really important to understand. Credits are more valuable than deductions. Credits reduce the amount you have to pay the IRS. Deductions simply reduce the amount of income that's subject to that taxation. And brackets are marginal, meaning that going into the next bracket doesn't change anything about how the first $5,000 or $10,000 of your income will be taxed. It will still be at that 10%. Now, for business owners, there are a couple extra things that we need to consider. And the biggest misconception I see for business owners is that in pass-through entities, people are sometimes reluctant to take cash out of their business bank account for fear of additional taxation. Well, unless you have a C corporation, that's not quite how it works. So, with a sole proprietorship, an LLC, or a subchapter S corporation, or even if you're an LLC taxed as an S corporation, you will be taxed on that cash left over in the business bank account no matter what. And it goes something like this. If you have that ice cream cone business, maybe you have enough transactions to where you want to have a bank account specifically designated for business activities. Maybe you take Visa cards to sell your ice cream. That's where the bank deposits, the business checking account is where the bank deposits those proceeds, things like that. That's where you pay your expenses and write checks out of. Well, in a sole proprietorship, if you've not done any organization, you've not formed any type of specific or explicit business entity, I should say, you have a sole proprietorship. And so all those revenues and all those expenses are listed out on your own personal tax return. You don't have to file a separate tax return. It goes on your personal return on Schedule C, where you list out $150,000 of revenue. You fill out the worksheet on Schedule C. You list all the various expenses. You have $50,000 worth of expenses. You're left with $100,000 of self-employment income from John's ice cream business. Well, you will pay tax on that cash whether it remains in the business account or not, because it goes on your own tax return. You're responsible for all the revenues and all the expenses. And it doesn't matter whether you take the $100,000 left over at the end of the year and put it in your personal bank account, or whether you leave it in the business bank account for working capital or reinvestment or whatever. The only way to not pay tax on that is to find other qualifying deductions or expenses. Maybe you go out and buy some equipment. Maybe you want to set up another stand on the other side of the neighborhood and you hire somebody, right? Those are all expenses that you can write off through the business. They show up on Schedule C of your tax return. And then instead of paying tax on $100,000, maybe you're only paying tax on 75 of it if you can come up with $25,000 of eligible business expenses. Another way is you set up a retirement plan for yourself. You put some money that's sitting in the bank account into a qualified retirement account for yourself, or either personally or through the business. You can deduct that contribution. So now you're paying tax on less than $100,000 as well. But it doesn't matter, again, and this part's important, whether or not the cash remains in the business bank account or whether you take it out and put it into your personal bank account. The taxation is exactly the same. Now, for an LLC, same idea. You may have gone to the trouble of organizing an LLC. You have an operating agreement, perhaps, or a membership agreement. All the revenues and expenses are still reported on your Schedule C if you're the only member. If it's an LLC and you have other people have ownership interests in the organization as well, then you have to file a tax return for the organization. And in that case, let's say you've got a 50-50 partner. You're John and your friend's name is Jerry. I should have named him Ben and Jerry. Thinking of that would be much more appropriate. John and Jerry's ice cream. They're going to try to compete with Ben and Jerry. You take the $150,000 of revenue. You report the $50,000 worth of expenses on this 1065 partnership return. And of the $100,000 left over, because John owns 50% of the company and Jerry owns 50% of the company, each of John and Jerry are responsible for paying tax on the $50,000 left over. And that's distributed to both owners through what's called Form K1. And this is the whole reason why pass-through businesses like multi-member LLCs and S corporations have a tax return deadline of March 15th instead of April 15th. It's because you need to get the business return done so that the business can send the K1s back to John and Jerry as 50/50 owners so that John and Jerry know what to put on their own tax returns, what they need to report as taxable income and pay tax on. So it's a little bit different in that regard, but it's still the same rules with regard to cash management. If John and Jerry have 50/50 ownership, they have $150,000 of revenue, they only spent $50,000 to run the operation, they have $100,000 in profit, they're both going to pay tax on an additional $50,000 of self-employment income. But if the cash stays in the bank, it doesn't matter whether it's there or whether they take it out and put $50,000 a piece in their own personal accounts. It's a pass-through business entity. The owners are responsible for the taxation on those profits. Here's another example, and this is where people get most tripped up, I think, is if you have either an S corporation or an LLC that's taxed as an S corporation. As we've talked about on the show in the past, when you have an S corporation, let's take the easy example where you're the only employee in the business and you're not, you have 100% of the ownership, you're not splitting it 50/50 with Jerry. If you have $150,000 in expenses, or excuse me, revenue, you have $50,000 of expenses, you have $100,000 left over. In this scenario, with an S corporation or an LLC that's taxed as an S corporation, you have to pay yourself a W-2 salary. And that might be half of all the money left over. So you might have to take out half of the money and pay yourself as a W-2 employee. And that $50,000 that's left over after you've paid yourself a W-2 income is the profits in that business for the owners pro rata. And in this case, you own 100% of the company, so you get 100% of that 50 grand left over. But again, in this scenario, even though you paid yourself $50,000 from W-2 payroll and took $50,000 out of the account, paid payroll tax on that, the other $50,000 that's left over in the business account, it doesn't matter whether the cash stays there or whether you take it out and put it in your personal account. You, as the 100% owner of the corporation, are responsible for taxation on that $50,000 either way. So if you leave the cash in there, the business will file its tax return. Again, it's due March 15th. The business will send a K1 back to you to report the $50,000 of income left over, and you have to pay tax on the 50 grand. Or you have $50,000 left over at the end of the year. You take it out, you cut a check from the business to yourself, you deposit the check in your personal bank account. You're still going to get the same K1 for $50,000. The taxation is identical. And so a lot of times people are confused around that topic of, do I leave the cash in there? Do I take it out? Honestly, it doesn't matter. You should have some kind of strategy for when and how you take cash out of the business. You need enough to finance your operations and potentially your growth and do all the things that you want to do in the business. But then anything that accumulates in excess of that, you might want to pull that out and bring it over to your personal accounts for investments or retirement account contributions or to pay down debt or some other means. But it's a distinction that's really important because I think a lot of people are not sure what to do and they don't want to pay any more in tax than they have to. And that's when cash starts to accumulate more so and more so in the business account. I see a lot of people that just have way too much cash in the business because they're not really sure what else to do with it. But there are far more efficient uses of that cash long term than letting it just accumulate for fear of doing the wrong thing. Coincidentally, that's something that we do a lot of in our financial planning firm for people because there's a far more effective use of cash to pay off the auto loans, pay off the house, fund the retirement accounts, and even invest it in a boring old taxable account. There are a lot of things that you can do that are more effective than letting that cash sit, even in a savings account, but especially in a checking account, earning very little interest. So I hope this was helpful. This is a little bit of a shorter episode, but I wanted to cover these basics because it's been a while since we've talked about them on the show. We're in the middle of tax season. And as I said at the beginning of the show, just be nice to your tax preparers this year. Try to get your data into them as early as you possibly can. If they need to extend your return until later in the year, it's really not the end of the world in almost all circumstances. But just keep those things in mind because accountants have had a tough go of it the last couple of years, and there's no sunshine in sight. I'm afraid. I don't know what accountants are going to have to do to attract newer people to the industry. Maybe manage the workflow a little bit better, so busy season isn't so hard on them. But it's a situation that a lot of people are in right now, and so if you're struggling to find a tax preparer yourself, you're not alone. And if we did that at our firm, I would tell you all about it, but we don't do that at this point. So, okay, let's call it a day. Thanks everybody for listening, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.